football, the red zone is where a team has to make small adjustments to ensure victory. As you approach retirement, you also need to make small adjustments to ensure success. This is the Red Zone Retirement Program with registered investment advisor and enrolled agent John Mears of Mears Money Management.
This week on the podcast, we're going to take some email questions from folks checking out the show on YouTube and Spotify and all that kind of stuff. And just, John, kind of deal with some of the stuff that people are reacting to, right, with the market volatility. So you doing all right this week, my friend?
Yeah, doing good. We're recording this right after Easter. There's still a lot of fun going on. And in fact, as we're recording this, there's a lot of fun going on. So people have legitimate questions.
Yeah.
And it's something that I think on my side of the desk, I'm very calm. I know on the other side of the desk, people are not. Sure. And so I have to have some empathy for that and answer people's questions and try and walk people off the ledge, so to speak. So exactly. I'm happy to do that. And there are, thank goodness, there are actual techniques and methods we can use to help all you out.
Yeah. Yeah. And, everybody gets a little nervous, understandable. Sometimes people are, they've got a good strategy in place. They're able to just kind of like, okay, I'm cool. But sometimes it gets to you and you got questions and that's okay. So let's see what Tina we've got here in Northridge says. She says, how do I know if I need to make a change in my investments due to the volatility, right? So what you say?
Yeah, that's a great question. And so I always tell people when the market's dropping and you're kind of worried, I always tell people, wait it out is not a strategy. That is not the strategy. Before you get to this point, you need to, I always tell people, you need to know your number. And people go, what do you mean I need to know my number? You need to know your number. And the number you need to know is, and I've geeked out about this before, your standard deviation. You have to know that. And if you say to yourself, I have no idea what that is, my advisors never talked to me about that, then you're already broken. Before the markets have gone up and down, you're already broken because you need to know what your standard deviation. What that means is the standard deviation is your volatility. What is the range of expected returns you should have within your portfolio? So if you tell me, by the way, I own NVIDIA and whatever sexy stock is out there,
right?
You have to know what your volatility is. You have to know what your range is going to be. And I will submit to you that an individual stock is going to be a wide range. Doesn't make that stock good, bad, or evil or whatever, but you have to know what's expected. When people come to me, I have one goal with every single client. I'm assigned that I cannot let anybody run out of money.
Right.
That's just it. I can't let anybody run out of money. So I develop a portfolio. And off that portfolio, then I will tell the client what your range of expected returns are. For example, if a standard 60-40 portfolio, that's 60% stocks, 40% bonds, the expected return, we'll call it around 7 or 8%. We'll use 8% for some simplicity here. The standard deviation off of that, and we can measure that. It's a mathematical calculation.
Right.
The standard deviation, the volatility is 10%. So that means your expected returns are plus or minus 10% off of your the historical returns. So if you average around 8%, down 10% would be -2, up 10% would be +18. That is what your normal expected return should be most of the time. That doesn't mean we can't go to what we call the second standard deviation, which would be adding another 10% on that. Mm-hmm. If you remember from your college stats classes, which I know none of you do.
Oh yeah, I'm totally recalling that right now. Yeah.
Yes. Favorite class for everybody.
Right.
So the first standard deviation is what you can expect 65% of the time. The second standard deviation is 95% of the time, roughly. So when we get to that second standard deviation, if we ever get out beyond that, then things have really gone flukish and weird. But we're trying to keep you within that first standard deviation, which means 2/3, 3/4 of the time you're going to be in this range. If you don't know what that is, you're going to be surprised whenever anything happens in the market, up or down.
Gotcha.
So rule number one, Tina, is you need to know your number. After that, then we can talk about whether you need to stay the course or not. But most people that know their standard deviation don't worry about staying the course. They already know where they're supposed to be at. They're very comfortable in that.
All right. Great question, Tina. Thank you so much. Let's jump over to Mark in Ventura. Says, how do I protect myself, coach, without locking in the losses? All right. I mean, that's, right. We panic, we sell, we know we're not supposed to, we lock in the losses, right? I mean, it's understandable, but that's what we're not supposed to do. But it's hard whenever, you're like, oh my God, I'm losing there.
Yes.
But,
Yes, so there's two things here that are in place, and when we talk about intellectually, you're going to hear what I say, and you're going to go, okay, he's right about this. And the first thing is what Dad will always say: when the market's down, that's the time to buy. We already know that. So the simplest way to handle this, though, is again, without getting on the internet at 3:00 in the morning, without your pupils getting dilated, is really to rebalance. We have spent time, again, if we have planned. Now, if you haven't planned, then all that we're talking about today is going to be secondary. But if you have a plan, you're going to know that you have a target. Again, if my goal is to make sure you never run out of money, and our goal is to have a 60-40 portfolio, then our goal should always be get back to 60-40 whenever we get out of whack. What that may be, who knows? And we let it breathe a little bit. It's not something we do a knee-jerk reaction within a day or two or a week. It's something where we kind of let it work its way out, because as we have seen in the last month, markets could be up, the markets could be down. We have a 10%, we have craziness going on all the time. So we let it breathe a little bit. And then if it's down for a period of time, then we may rebalance. And what that means is your 60-40 portfolio has all of a sudden become, we'll say 50-50 or 40-60, where you have only 40% stocks. So what we want to do when we're rebalancing is we want to skim some of the profits. And right now, we're going to talk about this in a little bit here as well. Right now, bonds may be up or international may be up. So we want to skim some of those profits and buy the stuff that's down. And that's counterintuitive to what you're thinking right now. You're going, well, the S&P's down. Well, again, this is an opportunity. So skim some of the profits, buy the stuff that's down, get right back to our pre-arranged, pre-planned portfolio. And that way you can, without emotion, buy low and sell high over and over and over. So this is a tremendous opportunity. Now, there is another opportunity with the markets being down here, and that may be you can kind of bank some losses right now. Now, one thing about ETFs and mutual funds, there is some latitude. When you sell an ETF and buy one that's very similar to that, you can do that legally without getting exposed to wash sale rules.
Right.
So that's something to consider, is maybe selling something and buying something very similar to that and banking some of those losses while the market is down. And one other thing I like to point out to people is we're always looking for Roth conversions, right, folks? Especially you that are in your early years of retirement.
Mm-hmm.
Market's down. There's an opportunity to go ahead and do your Roth conversion. So I know things are kind of tough, but let's look at the opportunities that are there. Really, let's get intellectual here. Let's do things, deliberate and intentional. Markets are down. It's going to happen. We may not like why it's happening, but it's happening. And so we need to take advantage of that. We ought to look for the opportunities instead of sitting around wringing our hands.
John has a couple of free books, Diffuse and Tax-Free Retirement in California, that reveal exactly how you can experience zero taxes in retirement and overcome the IRS lien on your 401k, IRA, and 403b, which could threaten your future lifestyle. These are complimentary, so all you have to do to pick these up 100% free is just stop by rescuemyretirement.net. That's rescuemyretirement.net. Fill in the basic info and he'll ship those out to you immediately. That's rescuemyretirement.net for a copy of Diffuse and Tax-Free Retirement in California.
All right, so we're back here. We're going to take another email question, Coach. So, we've got some good stuff from folks this week, right? It's all about the market. It's all about dealing with, some of the stuff. And I get that, depending where you're at, right, the panic changes a little bit, right? Because if you're right at, like, if you're going to retire this year, you're a lot more nervous than folks who are just a couple years out or, even 5 or 7 years out. Everybody panics differently based on no one likes to see their money go down. But obviously, if you're right there at the door, that changes things. So, and with any of these questions, right, please check with your advisor before you take any action. If you don't have an advisor, please reach out to John. Get yourself on his calendar. We just showed you the commercial. You can get his books if you'd like to do that. You can go to bookachatwithjohn.net. But either way, talk with a qualified professional before you take any action. But let's go ahead and get back into some email questions, Coach. We got Arthur in West Ranch, and he says, buy the dip or wait it out. Pretty simple.
Great question, because people are asking that question right now. And some people have had money that they've had in either money markets or ever since money markets are back into play, and we're getting paid interest now on our accounts. People have had money, but again, intellectually, people know I really should be in the market, though. I can't just be sitting in cash forever. Now, some people do realize there's an opportunity to buy. What a lot of people have is that fear of, okay, I'm going to dump money in, and then tomorrow it's going to go down another 2 or 3%, or it's going to go down 5 or 8% in the next month. That's a real concern right now. The market is extremely volatile. So my little trick that I tell people, if you have a chunk that is sitting on the sidelines and you kind of know this is an opportunity, but you can't quite pull the trigger, an easy thing to do is to dollar cost average into your account from whatever you have sitting in cash. Figure out what you may want to do over the next 12 to 18 months and just kind of divide it up. So let's just say you had $1 million and you wanted to dollar cost average that into the markets. Do $80,000 to $100,000, or if you want to do $50,000 a month. I have several clients that are doing this as we speak. It's just an easy way to kind of work your way into the market without that fear of buying out at an extreme high or low. This lets you get into the market systematically, again, without emotion, deliberately and intentionally, knowing that you have to get into the market while the market's down. Just do it in chunks. That's all you got to do. 6 months, 12 months, whatever makes you feel comfortable. But there's a great way to do that is to, instead of just buying the dip, following the guy that we know who we're talking about on CNBC, instead of just doing what he says, let's just kind of work our way in.
Yeah. And, to your point on the prior email question too, right? I mean, there is opportunities when the market is down, right? It's evaluating the situation, looking to see what that is, whether it's tax loss harvesting, whether it's buying the dip, whether it's, Roth conversions, whatever the case is, there are certainly things to look at. And again, if you're right there at the door, if you were going to be pulling money from these accounts this year, well, the sequence of risk,
we can talk about that.
We can talk about that. That's a totally different animal, but still make sure that you're having a conversation with your professional. We got one more question here. We'll finish up the podcast this week, Coach, with this one. Linda in Dallas. She says, everything's going down at once. So what's the point of diversification? That's the point. But anyway, you break it down for us.
So I've heard this from people, several people. This happens all the time. Whenever the markets are down, they say, everything,
yeah.
And that's not true.
Yeah.
And I tell people that's simply not true.
Yeah.
In fact, in preparing for the podcast and preparing for Linda's question, I actually pulled up one of our portfolios. This is a simple portfolio that we have, a 60-40 portfolio. And I am looking at the stuff that is up as we're recording this. This is Easter. And we've already had this volatility now for over a month. And we've had the new administration in for a couple months here. I'm just looking here. Obviously, the money markets are still up around 4%.
Okay.
You still earn money there. We're going to have a little bit part of our portfolio there. I'm looking at short-term bonds, foreign large value. That is up 8.9% year to date. Europe stock, foreign large blend. I'm just going inflation protected bonds, short-term bonds. I'm just going through this, folks. World bonds and then ultra short bonds. So bonds are up. We have some European stocks. We have some international. The point to diversification is so that we have things that are not always moving in the same direction.
Right.
So we want to make sure that we have, we call that, the term for that is negative correlation. But what we want is stuff that is going up when the other thing's going down, the other thing's going up, the other thing's going down. We want to make sure we want to smooth out the ride. What that means is that year your brother-in-law gets 30% on the S&P, we're all going to be clapping for him and we're happy for him. But that is not sustainable because he is all in one area. And then when the markets are down, he's going to complain everything's down. That is simply not true. This is why we diversify. We diversify to smooth things out. So a typical portfolio with what I'm working with right now, I've got the numbers up here. Year to date, a 50-50 portfolio is down 1.1% and a 75% stock portfolio, the ones that I manage, again, everybody's different, but they're down about 2.6%.
I'm
not good.
Yeah, I'm so glad you said that, though, right? Because you look at the year to date on the S&P. If you go Google it right now while we're talking, it says it's down 11 point whatever for the year, right? Year to date. Mm-hmm. Well, people go see that and they go, I'm down 11%. We just talked about this 2 weeks ago. You're probably not unless you're 100% in an index that's following the S&P or the Dow or whatever, right? So, and think about the Magnificent Seven, but everybody watching this show probably is familiar with that. They make up the majority of the S&P. So if they're down, so if tech is down, yeah, it does feel like everything's down at once to her point, but to your point, it's not.
Yeah, this is why it's boring. I get it, folks. Yeah. I do. I get that this is boring to talk about diversification and rebalancing.
But times like this make it important though, right?
This is why it's important. Exactly. This is why I'm going to use my little football terminology before we go here. This is why blocking and tackling is what matters in football. It's not fun to talk about it. Right. There's times when we're trying to develop a team and it gets a little ugly because we're just trying to learn to do certain things. But in the end of the day, we're trying to win games.
Yeah.
And sometimes it's not always pretty, but we know the fundamentals. We know what it takes to do that. So in your portfolio, if you don't want to run out of money, the best thing to do is to diversify prudently.
Yep.
And make sure we rebalance prudently. We have to do that. We have to have a plan. And this is why, this is why I have a job. And this is why it's so important for folks to kind of not get emotional about it and really talk to your advisor or talk to me about how this will fit into your life.
Yeah, right. We all love to see the 40-yard bomb, Coach, but that's what puts the butts in the seats. But if they're not blocking and tackling up front, right, he can't throw the 40-yard bomb, right? So, I mean, it's just it's just basic stuff, right? And it's funny how humans are that way about so much stuff, right? We want to. You and I were just talking. I just went into we're talking. We taped this just after Easter. I was just at the first round playoff games for my team for hockey. And without the grinding, we all love to see the goal. We all love to see a big hit, right? But without doing the fundamentals, they don't win the game, right? So
yes,
same thing with when it comes to our finance, and it's not sexy. Doing the fundamentals, but it gets us there, right? So great questions, everybody. Thanks so much for submitting them in. Thanks for checking out the podcast, obviously in audio form, video form, all that good stuff. You can find us on Apple, Spotify, whatever podcasting app you like to use. Of course, YouTube as well. Please subscribe to the show if that way if you enjoy it, where you catch new episodes when it comes out. Hit the thumbs up and the notification bell to support the channel, and that would be awesome. And of course, if you have questions, need help, please, again, sit down with a qualified pro like John. He's been doing this for many years, helping folks. You can find him online at bookachatwithjohn.net. That's bookachatwithjohn.net. We got that popped up on the screen for people watching. But if you're listening, there's also links in the description to mearsmoney.com, which is John's main website. Lots of good stuff for you guys to check out and reach out to him and get started today. Coach, thanks for breaking it down, buddy.
Yes, thank you. It's a lot of fun.
I always appreciate you, my friend. We'll see you next time here on Red Zone Retirement Program, Simple Investing, Smart Future with Coach John Mears.
Advisory services offered through Mears Money Management, Inc., an RIA registered in the states of California and Texas. California Department of Insurance License number 0685203.